The first important element to introduce is that the sum of current account balances over time gives us an accounting value for the international investment position of the United States of America. However, this book value or accounting measure of the net international investment position is not really a good representation of how much the United States owe to the rest of the world in terms of financial assets. The reason is that the current account balance record only the historical value of the difference between income and expenditures. However, the investments that are made both by United States investors buying assets in the rest of the world and investors in the rest of the world buying assets in the United States, the values of these investments changes over time, changes any second on financial markets. And so depending on how this value of these investments evolves over time, the market value of the net international investment position will change over time. In the next couple of slides, we will analyze exactly what are the implications of having a change over time of values of financial assets and how this might impact on the calculations for the net international investment position. We will discover that, in particular, the United States have been investing abroad mainly in stocks, in equity. So these are investments that have a relatively high return on the investment. On the other hand, investors that have been financing the current account balance of the United States, and so investors that have been acquiring United States-based financial assets, have mainly chosen low-risk assets, so treasury bonds and these sort of investments. So their total return on the investments by foreigners in the United States have been relatively low. Now, if the return of assets owned by residents of the United States abroad is higher than the return on assets owned by foreigners in the United States, then the net international investment position at book value is overestimating the liability that the US has to international investors. So we will present an example that explains in detail what it means for correcting for the market value of assets entries that appear in the balance of payments. And then we will go and look at concrete data and see that actually the total return on equity owned by US investors abroad has been roughly 10%, while the equivalent for investments of foreigners in a financial asset in the United States has been 6%, giving us the indication that the overall value of the net international investment position, which is about $8 trillion or 50% of GDP in the United States, is probably a little bit overestimating the amount of outstanding liabilities or outstanding debt that the United States have compared to the rest of the world.